Have you ever tried to catch a market reversal only to get stopped out as the trend kept going? That's because most traders try to predict the turning point instead of waiting for the market to confirm it. In this video, I'll show you 3 high-probability reversal trading strategies that can help you identify potential trend reversals with much greater confidence while avoiding many of the false signals that trap beginner traders. Here's what you'll learn in this video. Support and resistance reversal strategy. Trendline breakout and moving average crossover strategy. RSI divergence and liquidity sweep strategy. How to apply these strategies in Forex, stocks, cryptocurrencies, futures, commodities, and indices. How to trade them on all time frames, including the 1-minute, 5-minute, 15-minute, 1-hour, 4-hour, and daily charts. Before we get started, if you enjoy this type of trading content, make sure to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss a new trading video. Now, let's get started. The first reversal trading strategy is based on support and resistance. Take a look at this chart. This is the US dollar versus the Canadian dollar on the daily chart. As you can see, the market was in an uptrend before reaching this price level, where it reversed lower, creating a clear resistance level. Later, price returned to the same level and was rejected once again, confirming that sellers were defending this area. Now, look at what happened next. The market rallied back to the resistance level for a third time but was strongly rejected, forming a pin bar candlestick pattern. This pin bar tells us that buyers attempted to push the market higher, but were overwhelmed by sellers before the candle closed. In other words, sellers are still in control of this resistance level, increasing the probability of a bearish reversal. After conducting your top-down analysis and confirming that all the conditions align, you can enter the trade at the close of the pin bar. Place your stop loss just above the pin bar and set your profit target at the next major support level. Now, look at what happened next. As you can see, the market reversed exactly as anticipated and reached the target, providing a high probability reversal trade. Now, let's look at another chart example. As you can see, the market was trending lower before reaching this level, where it found support. Price tested the level a second time, and then a third time, creating a well-established support level. Now that we have a clear support level, look at what happened next. The market retraced back to the support level and was strongly rejected, forming a clear bullish pin bar, which is a high probability bullish reversal signal. After confirming your top-down analysis, you can enter the trade at the close of the pin bar. Place your stop loss just below the low of the pattern and set your profit target at the next major resistance level. Now, look at what happened next. As you can see, the market rallied from the support level and reached the target as expected. Before you can trade reversals, you first need to know how to identify reliable support and resistance levels. Not every high or low on a chart is worth trading, so let me show you the 3 criteria I use. The first step is to identify the most significant turning points on the chart. A swing high is a point where the market rallies, reaches a peak, and then reverses lower. This area has the potential to become a resistance level because sellers were able to overpower buyers. A swing low is the opposite. Price declines, finds buying pressure, and then reverses higher. This creates a potential support level where buyers previously took control of the market. These swing points help you identify areas where supply and demand have shifted in the past. However, don't assume the market will reverse simply because it reaches one of these levels again. Instead, use them as areas of interest and wait for price action to confirm that buyers or sellers are defending the level. Once you've identified a potential support or resistance level, check whether the market has reacted to it before. A single reaction can mark an important level, but the probability of a successful reversal generally increases when price has respected the same area multiple times. Each additional rejection suggests that market participants continue to view that price as an important buying or selling zone, making it more likely to attract orders when price returns. One of the biggest mistakes beginners make is drawing too many support and resistance levels. The best levels are the ones that stand out immediately. You shouldn't have to zoom in, adjust your lines repeatedly, or convince yourself that a level exists. When you look at a quality chart, the strongest support and resistance levels are usually obvious because price has reacted sharply from them in the past. The reason these levels work so well is simple. thousands of traders are watching the same price areas. As more traders recognize a level, more buy and sell orders tend to accumulate there, increasing the chances of another significant market reaction. As a beginner, ignore the minor fluctuations and focus on the major support and resistance levels that are clearly visible. They are far more reliable and much easier to trade. Now, let's look at the last chart example. This is the Canadian dollar versus the Swiss franc on the daily chart. As you can see, the market was in a clear downtrend before finding support. Price tested this level once, then came back for a second retest, and finally a third retest. Since the market has respected this support level multiple times, it becomes a significant area that we can use when looking for a bullish reversal. When price reaches the support level again, a bullish engulfing pattern forms and is immediately rejected from support. This rejection tells us that buyers are stepping in and defending the level, increasing the probability that the market could reverse to the upside. Our entry is placed at the close of the bullish engulfing candle with the stop loss below the pattern. For the profit target, we simply aim for the next resistance level. Now, look at what happened next. As you can see, the market rallied higher and reached the target exactly as expected. The second reversal strategy is based on a trendline breakout combined with a moving average crossover. Let's look at this chart example. As you can see, the market is in a clear downtrend. The yellow line represents the 20-period simple moving average, while the blue line represents the 10-period simple moving average. The first step is to draw a trend line by connecting the first, second, and third swing highs. This gives us a clear trend line that the market has been respecting throughout the downtrend. Now, look at what happens next. Price breaks above the trend line, signaling that the bearish momentum may be coming to an end. Just before the breakout, the 10-period moving average crosses above the 20-period moving average. It's important to understand that we are not trading the moving average crossover itself. Instead, we use it as a confluence factor that adds confidence to the trendline breakout. Once the breakout candle closes above the trendline, you can place your entry at the close of that candle. Set your stop loss below the breakout candle and use the next resistance level as your profit target. Now, look at what happened next. As you can see, the market continued moving higher and reached the target as expected. Now, let's look at another chart example. This is the Canadian dollar versus the Japanese yen on the hourly chart. As you can see, the market is in a clear uptrend, allowing us to draw a trend line by connecting the swing lows. Now, let's see what happens next. Price breaks below the trend line, signaling that the bullish trend may be coming to an end. At the same time, we also have a moving average crossover, which acts as a confluence factor to confirm the breakout. To take the trade, place your entry at the close of the breakout candle, set your stop loss above the breakout candle, and use the next support level as your profit target. Now, look at what happened next. As you can see, the market moved lower and reached the target as expected. Before moving on, let me quickly show you how to draw a trend line correctly if you're not completely familiar with the process. Let's start with an uptrend. The first thing you need to do is identify a market that is making a series of higher highs and higher lows. This tells us that buyers are in control and that the market is trending higher. Once you've identified the trend, locate two or more significant swing lows. Draw your trend line by connecting the first major swing low with the next higher swing low, then extend the line to the right side of the chart. As long as price continues to respect this trend line, it acts as a dynamic support level. In other words, buyers continue to defend the trend, and the uptrend remains intact. However, once price breaks below the trend line, it signals that bullish momentum may be weakening. That trend line breakout becomes a potential reversal setup, especially when it's confirmed by other technical factors. Now let's look at a downtrend. In a downtrend, the market forms lower highs and lower lows, showing that sellers are in control. To draw a bearish trend line, connect two or more significant swing highs. Start with the first major swing high, connect it to the next lower swing high, and extend the line to the right. As long as price continues to respect this trend line, it acts as dynamic resistance, indicating that sellers are still controlling the market. A break above the trend line can be an early sign that the bearish momentum is weakening and that a potential trend reversal may be developing. Now, let's look at the last trading example. This is the US dollar versus the Swiss franc on the hourly chart. As you can see, the market is in a clear uptrend, which tells us that buyers are in control. To draw the trend line, we simply connect the first significant swing low with the second swing low and extend the line to the right. Now, let's see what happens next. Price breaks below the trend line, signaling that the bullish momentum may be coming to an end. At the same time, the 10-period moving average crosses below the 20-period moving average, providing additional confirmation for the breakout. To enter the trade, place your entry at the close of the candle that breaks below the trend line. Set your stop loss above the breakout candle and use the next support level as your profit target. Now, look at what happened next. As you can see, the market moved lower and reached the target exactly as expected. Before we finish, I'd like to leave you with one important note. This strategy is not a holy grail. No trading strategy wins 100% of the time. That's why proper risk management is just as important as finding good trade setups. Always control your risk, use appropriate position sizing, and never risk more than you can afford to lose. A solid money management plan is what allows you to survive losing trades and stay profitable over the long run. The third reversal strategy combines RSI divergence with a liquidity sweep. Let's look at this chart example. As you can see, the market is in a clear uptrend, which tells us that buyers are in control. Price creates the first swing high, followed by a second, slightly higher high, forming what looks like a double top. Now, let's compare price with the RSI. We connect the two swing highs on the price chart, then connect the corresponding highs on the RSI. Notice the difference. Price is making a higher high, while the RSI is making a lower high above the 70 level. This is known as bearish RSI divergence, which tells us that although price is still pushing higher, bullish momentum is beginning to weaken. It serves as an early warning that a potential reversal may be approaching. Next, look at the resistance level. Price briefly breaks above the resistance, attracting breakout buyers and triggering the stop losses of short sellers. However, instead of continuing higher, the market quickly falls back below the resistance level. This is a classic liquidity sweep, showing that the breakout has failed and that sellers have regained control. At this point, we have two powerful factors lining up: a bearish RSI divergence followed by a liquidity sweep. Together, they create a high probability reversal setup. To enter the trade, place your entry at the close of the candle that closes back below the resistance level. Set your stop loss above the liquidity sweep and use the next support level as your profit target. Now, look at what happened next. As you can see, the market moved lower and reached the target exactly as expected. Now, let's look at another chart example. This is Ethereum versus the US dollar on the hourly chart. As you can see, the market is in a clear uptrend, which tells us that buyers are in control. Price then forms a double top. This is the first top, and this is the second top. A double top suggests that buyers are struggling to push the market higher. Despite two attempts, price fails to continue the uptrend, which is our first warning that momentum may be fading. Next, let's compare price with the RSI. We connect the first top with the second top on the price chart, and then connect the corresponding highs on the RSI. Notice what happens. Price makes a higher high, while the RSI makes a lower high. This creates a bearish RSI divergence, indicating that bullish momentum is weakening and that a potential reversal may be approaching. Now, look at the resistance level. Price briefly breaks above the resistance, but quickly falls back below it. This is a classic liquidity sweep, where the market traps breakout buyers before reversing in the opposite direction. At this point, we have two strong reversal signals: a bearish RSI divergence that warns us the trend is losing momentum, followed by a liquidity sweep that confirms the reversal. To enter the trade, place your entry at the close of the candle that closes back below the resistance level. Set your stop loss above the liquidity sweep and use the next support level as your profit target. Now, look at what happened next. As you can see, the market moved lower and reached the target exactly as expected. Now, let me show you how to use the relative strength index to identify divergence. First, use the RSI with its default settings on TradingView. When looking for divergence, we only focus on signals that occur in extreme momentum zones. For a bearish divergence, the RSI should be at or above the 70 level, indicating that the market is in an overbought condition. For a bullish divergence, the RSI should be at or below the 30 level, indicating that the market is in an oversold condition. By combining RSI divergence with overbought and oversold conditions, we can filter out weaker signals and focus on higher quality reversal setups. Let's look at this example. As you can see, price is making lower lows while the RSI is making higher lows. This is known as a bullish RSI divergence. Notice that the divergence occurs below the 30 level, which tells us that the market is in an oversold condition. This doesn't guarantee that the market will reverse immediately, but it does tell us that bearish momentum is weakening and that buyers may soon step in. That's why we don't trade the divergence by itself. Instead, we wait for additional confirmation, such as a liquidity sweep or another price action signal, before entering the trade. Now, let's look at the last chart example. This is the US dollar versus the Swiss franc on the 1-hour chart. As you can see, the market is in a clear uptrend. We also have a well-defined resistance level that price has been respecting. Now, look at what happens next. Price breaks above the resistance level but quickly reverses and closes back below it. This is a classic liquidity sweep, where the market traps breakout buyers before reversing to the downside. Next, let's examine the RSI. While price makes a higher high, the RSI forms a lower high, creating a bearish RSI divergence. This tells us that although price is still moving higher, bullish momentum is weakening and a potential reversal may be developing. At this point, we have two powerful factors working together: a bearish RSI divergence that warns of weakening momentum and a liquidity sweep that confirms the reversal. To take the trade, place your entry at the close of the candle that closes back below the resistance level. Set your stop loss above the liquidity sweep and use the next support level as your profit target. Now, look at what happened next. As you can see, the market moved lower and reached the target exactly as expected. That brings us to the end of this video. If you found it helpful, make sure to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss a new trading video. Thanks for watching, and I'll see you in the next one.